What are some year-end financial planning strategies that you might consider? Well, here to talk with me about that is Philip Herzberg from Team Hewins. Philip, welcome.
Thank you, Bob. It's great to be talking with you about year-end planning. Thank you for inviting me.
It's a pleasure to have you here, and this video and your article will benefit a good many people. Let's start with you in the article mentioned at least six financial planning strategies to finish strong. Let's go through them.
Yeah, and one of the first proactive planning moves to make and save more money now and in the future is simply to boost retirement savings, and that's the first proactive move you could make here. So continue to stick to your long-term plan by adding to your tax advantage retirement accounts, your Roths, your traditional IRAs, and your traditional 401k. So foremost, maximize your traditional or Roth 401k contributions for the year 2023 if your cash flow situation allows for it. If you're under the age of 50, you can contribute up to $22,500. And if you're over 50, you can add what's called a $7,500 catch-up amount. So you'll want to increase your paycheck deferrals to a traditional 401k account if you want to lower your taxable income dollar for dollar. It's important, while many people have traditional or Roth or Roth 401k, 403b type of accounts, if you have some other type of retirement plan or IRA, speak with your CPA to see how much you're eligible to contribute.
Right. And many workers have HSA accounts or FSAs at work. What about those?
Yeah, definitely. One of the things you'll want to do if you are privileged to have one of these type of accounts, what's called a health savings account, an HSA, or a flexible spending account, what's called an FSA, you'll want to review the spending that you've done this year. HSAs, the health savings accounts, have become increasingly popular. They're uniquely triple tax advantaged, and the HSA paycheck deferrals reduce taxable income. In being triple tax advantage, they reduce taxable income, earnings can grow tax-free, and then the qualified withdrawals are used to pay for qualified medical expenses, and those are also tax-free. So that there's a triple benefit there to having that health savings account. Now, it's important to know that folks who have HSAs can contribute in 2023 up to $3,850 for self-coverage, and up to $7,750 for family coverage. And each individual age 55 and older that is covered can put an additional $1,000 in this high deductible health plan. So, it's important to review the HSAs. It's also, if you do alternatively have what's called a health flexible spending account, an FSA, they can also, as the year goes by, the balance remains unspent that you've been deferring through your paychecks until year end. So these accounts are use it or lose it. Paycheck deferral money does not roll over into the new year. There may be a certain amount. You got to check your employer your plan, but you should utilize this FSA money on qualified medical, dental, or vision expenses during the last weeks of the year while you can, so that this money is not wasted.
A lot of folks are often asked about Roth IRA conversions. Is that another planning strategy to consider?
Oh, absolutely. At this time of the year, you should have a good idea, of what your income and your expenses and even your deductions look like. So I think that can really help set the stage for a small or more of a larger Roth IRA conversion. Now, Roth IRA conversions are also more appealing for those who are in a great position to take advantage of this strategy in a historically low tax rate environment. So the stock market decline within the last 2 years has enabled investors to convert a larger portion of an IRA with doing a Roth IRA conversion and enjoy this tax-free growth, as well as possible tax-free distributions in the future inside the Roth with the eventual stock market recovery. And just another Roth conversion incentive here, especially with lower prices and lower values being converted because of the decline in the stock market and as well as the bond markets, is a lower tax bill. So the liability for a conversion would be cheaper now than it had been when the markets were elevated. So just be sure if you're thinking about converting some of your traditional IRA to a Roth IRA, conversion funds, they got to be out of that pre-tax IRA account by December 31st, 2023. The other important caveat here with considering a Roth IRA conversion is that there may be several possible unintended consequences that may come with the extra income from a Roth IRA conversion. So what is common is that Medicare premiums and capital gains tax rates can increase along with a Roth IRA conversion, because Roth IRA conversions can increase taxable income. So advisors, they need a complete set of facts before making a recommendation for a Roth IRA conversion. So seek the guidance of a qualified tax and CFP professional, certified financial planner, or CFP professional to evaluate whether a Roth conversion is advantageous for your situation.
Some folks can also save tax money by making charitable donations from their IRA too, Philip?
Yeah, they sure can. IRA required minimum distributions, or RMDs, are fully taxable at ordinary income tax rates. So anything in terms of any reduction or elimination of the amount that you'll take out from your required minimum distributions, that's going to enhance your tax situation. So those who are philanthropically inclined and are not able to annually itemize deductions can utilize what's called qualified charitable distributions, or QCDs, which is a direct transfer to a qualified 501c3 organization charities from an IRA. So that's an impactful strategy to save money on taxes. For those individuals age 73 or older in the year 2023, a significant positive of using this qualified charitable distribution, or QCD strategy, is that you can satisfy your IRA required minimum distribution by directly donating up to $100,000 of the required minimum distribution in 2023 to charity from an IRA, and you pay no tax on what would have been a distribution taxed as ordinary income. A caveat here is that you cannot obtain a double tax break by taking a qualified charitable distribution and also claiming it and receiving an itemized deduction for a charitable gift. So rather than counting as an itemized deduction, qualified charitable distributions, or QCDs, for those taking required minimum distributions can help lower your adjusted gross income, which can possibly help you avoid future Medicare premium increases.
Right. What about folks who want to gift appreciated securities to charities?
Well, yeah, and similarly, a lot of folks could get a benefit by gifting appreciated securities to charity. So in the context of, individuals, single filers in 2023 have a $13,850 standard deduction, and married couples filing together in 23 have a $27,700 standard deduction. Many taxpayers, because of the higher deduction levels, they're not going to be able to itemize write-offs, so it makes it more challenging to claim a deduction for charitable gifts. So that's where great planning comes into play. So if you give annually, you may want to think about bunching these deductions with what's called a donor advised fund, or DAF, which enables donors to both give today and pre-fund years of gifting. So this flexibility over time can help you gain time to identify IRS qualified 501c3 public charities and causes that align with your values, while allowing you to claim the upfront deduction, that year, to save money on taxes. So this is a great and immediately impactful manner to gift appreciated securities to charities here. And you may ask what type of securities to utilize. Well, any type of appreciated securities such as stocks, mutual funds, or exchange-traded funds, ETFs, are good holdings to give to a donor advised fund. So you'll first want to check with the organization you're donating to ensure they can accept the securities. and more are able to do this and are eligible to accept the securities. So doing it in this way, you're basically getting more bang for the buck since you don't have to sell the stock, you can avoid realizing capital gains taxes, additional taxes, to make a direct gift.
Right. And Philip, some people might want to use a donor advised fund to do this.
Yeah, exactly. Donor advised fund is one of the most tax effective manners to be able to gift appreciated securities to charities. So it's relatively not challenging to set up with a provider. And again, it's a win-win situation in the sense that you get the immediate upfront deduction by gifting directly to the donor advised fund, and then it buys you time to be able to grant to the charities that you want to down the road.
What about large gifts to family members?
Yeah, so that's a great planning strategy in the sense that if you're looking at the gift tax exclusion as well as the lifetime gift and estate tax exclusion, you're thinking ahead about that. Making annual gifts to your heirs below the annual gift tax exclusions, a simple yet effective way to transfer money to your heirs while reducing the amount of money possibly subject to the estate tax. So in the year 2023, the annual gift tax exclusion amount is $17,000 per person and $34,000 for a married couple giving to one person. So another prudent strategy to pass money to your heirs is to directly pay family members tuition and education bills without incurring gift taxes. So a great benefit of that is it does not count against the annual exclusion, no matter how large those payments are, as long as those payments are directly made to the respective medical provider and education institution. So you can really move around large amounts of money out of your estate tax-free. You will not have to report gifts to the IRS if they're below the limits, and this will not eat up any of your lifetime estate tax or gift tax amounts. So these are important strategies to try to take it to leverage between now and the end of the calendar year.
And there are some estate planning laws that sunset in 2026. What do folks need to know about that?
Yeah, and it's important to think ahead. Folks really need to start thinking about leveraging the current 12.92 million as of 2023 for individuals, and for married couples 25.84 million federal estate gift and generation skipping transfer tax exemption before it sunsets on December 31st, 2025. Or it could, if you don't take advantage of that, this could possibly be reduced due to legislation. So you're going to want to transfer wealth and potentially minimize some of the estate and or gift tax burden. So for married couples, a smart strategy to consider is to think about using one spouse's full exemption instead of using a portion of each spouse's exemption. So if the exemption were to be reduced to the projected inflation-adjusted $6 to $7 million range in 2026, one spouse would still have their exemption. The other planning strategy to start thinking about is also possibly taking advantage of the increased lifetime federal estate tax exemption with techniques such as a spousal lifetime access trust or a SLAT, a dynasty trust, or even an irrevocable life insurance trust, what's called an ILIT. So before going ahead and starting to implement these type of estate plans, you're going to want to seek the guidance of an estate planning attorney in tandem with the help of a certified financial planner professional. So they'll help you determine an appropriate trust structure for transferring the wealth.
Philip, these are some great year-end financial planning strategies for folks to consider. Anything we missed or anything that just bears reemphasizing?
Yeah, I would, based on your situation, consider all of these items here. Please make sure you look at your paycheck and make adjustments as soon as possible between now and calendar year end. And take a look at taxable brokerage accounts and see if you have any appreciated holdings. And then you want to by the end of the calendar year, December 31st, 2023, make sure you have written out the checks to family members or to to take advantage of the annual gifting or lifetime gifting, as well as to any checks if you want to write them out to education providers or medical institutions if you want to help out family members.
Well, Philip, we really appreciate the opportunity to chat with you and have you share your knowledge and wisdom with our viewers and readers. So thank you.
It's my pleasure, Bob. I want to wish everybody here, happy, healthy rest of the year and 2024 ahead.